Welcome back. The Bank of Canada, of course, delivered a second straight supersized rate cut yesterday, lowering its benchmark interest rate once again by 50 basis points, this time taking the rate down to 3.25%. TD Bank says inflation is now less of a concern for the central bank. Growth, of course, is the concern. Let's bring in Beata Caranci. She is chief economist at TD Bank for a view of what's going on and the prospects for the Canadian economy. Beata, thanks a lot for joining us. I believe you and your team at TD are expecting the bank to continue to lower rates, but at a cadence of 25 basis points from here. Is that correct?
Yeah, not just 25 basis points, but not evenly at every meeting. So at this point, they have hit their neutral range, at least the upper end of what they had previously estimated. And, they need to be careful because you can overshoot and provide too much stimulus into the housing sector in particular and the consumer sector, because Canadians are highly interest rate sensitive, both on the way up and now on the way down, meaning there's a big impulse to spend when rates come down. So we only think that we can get 3 to 4 more rate cuts for the rest of next year. And markets have actually priced in less. They think that maybe we only get 2 more rate cuts. So everybody's in a holding pattern now, what they're going to do next. And
all the conversation now seems to be swirling around the neutral rate. What is the neutral rate and when will the bank get there? I think I hear you saying the neutral rate is about 2.25%. Is that correct?
For us, our estimates, we place it at the lower end of the range. So the Bank of Canada produces a range because nobody really knows what the neutral rate is. It's an unobserved variable. You only know once you've passed it because then you realize you've overstimulated an economy. So for the Bank of Canada, the range right now is 2.25 to 3.25. And that's why the policy rate is currently sitting inside their range, but at the upper end. We think that realistically, Canadian productivity has been non-existent, not just for a matter of like 1 year, but many years. And so we're probably looking at a lower neutral rate around 2.25. And that's why we have more price cuts than the market currently has right now. But we'll have to see because we don't even know yet what Trump's going to do in terms of tariffs on Canada, which would make the Canadian economy more vulnerable.
It was the most recent employment report from StatsCan that really cemented the view of bank watchers and the market, the fixed income market, that the BOC would cut by 50 basis points yesterday. What is your view of the Canadian labor market? Are we going to see more pain there? Are we going to see the jobless rate rise? And again, it's a market characterized by hiring, but not enough hiring to keep up with the growth in the Canadian labor force.
Yeah, so I think what we're going to realize in the new year is that there's a quirk happening in the methodology. And by that, I mean when Statistics Canada calculates the labor force growth off of population growth, it is basing it on past estimates of the population, so a 12-month moving average. So what's happened with government policy to reduce immigration, we've already seen a significant drop in non-permanent residents coming into Canada. It is not getting picked up right now by Stats Canada. So it is overestimating labor force. And by extension, the unemployment rate is rising to a greater extent than what's truly represented in our labor force. So I think in the new year, we're going to see some revisions when Stats Canada does finally like that mark to market to what the actual statistics are unfolding in Canada's population and labor force numbers. So that jump that we had in the unemployment rate last week, that pushed everybody's expectations towards a 50 basis point cut, and what even Tiff Macklin was referring to at the meeting, I think is a little bit of an overstatement of the amount of people who are unemployed in Canada right now, and we'll see that number come down. But overall, it doesn't detract from the point that they want to get to neutral. So it didn't matter what the data was going to say in the last 6 weeks. Between their policy meetings, the Bank of Canada was determined to get the policy rate into a neutral range so that it was not as restrictive on the economy as prior. And so I think even if we had an unemployment rate that didn't budge, they still would have did the 50 basis point cut.
Tiff Macklin was asked about some comments made by Stephen Poloz, his predecessor, yesterday during the news conference. Stephen Poloz has said that if you look at per capita data, Canada is in a recession. And Macklin answered that question by saying, well, look, there's still hiring going on in this economy. There were 50,000 jobs I'm paraphrasing here, but he pointed to pretty clearly the fact that there were more than 50,000 jobs added to the Canadian economy during the month of November. What's your view? Where do you come down on this distinction between what we see when we look at per capita economic growth and what we see when we look at aggregate economic growth?
Yeah, I would agree with the way Tiff Macklem positioned it yesterday. Effectively, when you think through recession-type dynamics, you're looking at, are people's incomes declining? Is the job market declining? It's not just a GDP metric, and it's certainly never been a GDP per capita metric. So when you look at not just job growth remaining there, and we had 50,000 jobs created last month, which is terrific, you also see income growth at about 4% in Canada. These are not indicators of recession. And so I don't think that you could put Canada into that camp. I think, Stephen Poloz was making the broader point that this is quite a weak economy. And he was making the point that the population has masked some of that weakness. And I think that's been well understood, but I definitely wouldn't characterize it as recession.